Well, natural gas bulls managed to finish the week with another small victory, but once again, they stopped just short of doing anything truly dramatic. September NYMEX natural gas finished Friday around $2.75, gaining about 1.5% for the week and marking a second consecutive weekly advance. The rally was supported by persistent summer heat and expectations for strong power sector demand. Forecasts continue to show above normal temperatures into early September, while Texas electricity demand is approaching, and potentially challenging, previous records. Nevertheless, production remains extremely strong, inventories remain above the 5-year average, and the market is heading toward the fall shoulder season. The EIA currently expects Henry Hub to average only $2.87 in Q3, citing record production and reduced LNG feed gas demand. The latest EIA storage report was actually encouraging for the bulls. Working gas increased by only 16 billion cubic feet for the week ending August 14, bringing inventories to 3,169 billion cubic feet. That was close to expectations and dramatically below the previous week's 36 billion cubic feet injection. Stocks are still about 6.2% above the 5-year average, however, so the market is not exactly running out of gas. The important point is the direction of storage injections. A 16 billion cubic feet build in mid-August, during a period of strong cooling demand, suggests that hot weather is doing its job. Power sector demand is absorbing a substantial amount of gas, preventing inventories from building at a pace that would otherwise reinforce the bearish storage story. And next week's report could remain relatively supportive if the current heat persists. The weather picture is still favorable for natural gas. Forecasts are pointing toward continued above normal temperatures, particularly across Texas and the southern United States. That means elevated air conditioning demand and continued pressure on power generators to burn natural gas. This is exactly the kind of environment that can keep natural gas prices supported into the end of August. The problem is that weather forecasts have become something of a revolving door this summer. One model run adds heat, natural gas rallies. The next run removes some heat, natural gas sells off. Then another run puts the heat back. At this point, the weather models are basically trading the market themselves. LNG should provide another layer of support. Feed gas flows have been recovering as maintenance at several facilities winds down. Recent estimates put LNG feed gas around 17.6 billion cubic feet per day, with further improvement possible as maintenance concludes. That is important because stronger LNG demand can help offset some of the pressure coming from domestic production. However, the market still needs sustained LNG demand rather than a temporary recovery in flows. And here is where the bears get to clear their throat. U.S. production remains exceptionally high. The American Gas Association's latest market indicators describe the U.S. gas market as well supplied heading into the fall shoulder season, with strong production continuing to support supply. This is the fundamental reason why natural gas continues to struggle to sustain rallies above $2.80. The market has plenty of demand. That is why the bulls need to take advantage of the current heat window. Technically, the market remains constructive, but only cautiously. The most important level is still $2.80. Natural gas has repeatedly approached this area but has failed to establish a convincing breakout above it. Friday's close around $2.75 leaves the market directly underneath that resistance. Natural gas enters next week with a better fundamental setup than it had a couple of weeks ago. My base case is range-bound trading with a slight bullish bias, provided the weather remains hot and LNG flows continue improving. I expect the market to spend much of next week testing the $2.75 to $2.85 zone. The bull's mission is simple. Break $2.80. Hold $2.80. Then attack $2.90. If they accomplish that, a move toward $3 becomes increasingly realistic. But if $2.80 once again proves to be a brick wall, we could see another rotation back toward $2.70. And knowing natural gas, the market will probably choose the most complicated possible way to decide which one it wants to be. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.